What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and many of you have been asking frequently for me to finally get this video up, and it is here now. This is my video where I go over my price targets for the election. So, price targets on things like gold, silver, the stock market from now until the election, and specifically then, because I think once the election happens, there are multiple possibilities after the election depending on how it goes, and so my price targets are until that point. Now, for anybody here that doesn't want to watch the entire video and just wants to hear the numbers, here we go. Price target for gold by the election, 2,500. Yes, 2,500. For silver, it is $35. Bitcoin, I have two price targets just like last time, and they are 10,000 and 15,000. Now, I'm throwing a new one in here that I didn't do last time. This is GDX. This is the Gold Miners Index. And my price target for GDX is $55 a share. Treasuries, I have no change. I don't expect any change to happen with the rates of treasuries. For DXY, the dollar index, my price target on DXY is going to be 88. And then last, my price target for the S&P 500 by the election is 3,800. 3,800 for the S&P 500 by the election. And now, if you are interested in hearing why, the reasons behind those numbers and how I arrived at them, both technically and fundamentally, you're in the right place. Let's dive in. All right, first up on the list is gold, and I said my price target for gold by the election is 2,500. And I know that sounds like a crazy number, especially considering the pace at which gold has climbed recently. But there are a few reasons why I think gold will hit $2,500 per ounce by the election. The first reason, and it's almost the entire reason, is the short position of the bullion banks. And despite what they've been doing over the past couple of weeks, couple of months, they have not been able to significantly reduce their short position despite gold continuing to climb. Now, I've made plenty of videos about this before, but suffice it to say that the majority of the money that trades in the gold futures markets, which determines the price of gold, is short. Now, when you're short something, essentially that means you've borrowed in order to sell something you don't own. And so in order to close out that position, you have to buy it back to close it out. It's the exact opposite of if you own something, you've bought something, and in order to close out that position, you have to sell it to close out that trade. So it's the opposite. They are short net a massive amount, almost a record historically. And the last time that the bullion banks were at this level of net shorts and started to close it out and got back to a more normal and more neutral position historically, the price of gold rallied 30% in about 6 months. Now, the month of August was crucial for me, and that's why I was waiting until now to make this new updated price target video, because based on everything that they were doing and the delivery requests, it looked like they were going to have to start closing those positions out, and they were not able to significantly reduce their shorts. Adding to that fact is that hedge funds are more neutral now. So a lot of hedge funds pared down their gold positions so that altogether now hedge funds as a group is a lot more neutral. The longs and the shorts kind of balance each other out. This is significant because usually the hedge funds are the ones that are selling the gold to the trading desks at the bullion banks in order to allow them to buy back their shorts to close out their positions. And so the hedge funds being neutral right now means that they don't have any gold to sell to the bullion banks to help the bullion banks close out their shorts. Now, hedge funds are normally they're swing trading these moves in gold. And so the fact that gold did not significantly correct, did not significantly drop, and in fact established a new floor here right under $2,000, right above $1,900 per ounce, means that they're likely now to increase their longs to get back in and establish new positions, since they just took profits and they shortened out their longs, and they're likely to get back in now, since it's established a new floor. Because when over this last month, as they reduced their longs, it didn't drop the price at all. And then the last reason why $2,500 is my price target for gold is because the charts really support that. Considering the magnitude and the direction of the rally in gold, it looks like $2,500 would be the next natural breaking point after we break out of this consolidation that we've been in during the month of August. When we break out of that, it looks like a big run right when we break out up to about that $2,500 mark. Now, a little bit longer term, I'll just throw this in there as well. There's very little institutional allocation to gold across the investing universe. There's very little allocation to gold when you look at pensions and retirement funds. And so longer term, as real rates continue to be negative and more investment managers are looking for a place of, a solid store of wealth long term, that shift will continue to move a little bit towards gold. We've already started to see that just a tad bit. And so all of these things are tailwinds, and the institutional allocation, I don't expect that to be a really short-term thing. That's more of a long-term play. But the entire macro environment right now is bullish, especially, and number one driver right now is the short position of the trading desks. And so I do expect to see a big rally in gold over the next couple of months. Now we're moving on to silver. And again, I've talked about this before, but silver is in a very different position than gold right now. There's not a massive short squeeze currently taking place in silver. There's not a massive amount of shorts in the market. There's a supply squeeze on silver, absolutely. And so that is a tailwind. That is going to be a driver to help silver continue its rally. But there's not a short squeeze. There's not a massive amount of shorts in the silver markets right now. And so it is still bullish, and my price target on silver is 35 by the election. And that's driven again by both things, the fundamentals and the technicals. 35 is a major point of resistance historically for silver, and so I expect the rally to at least pause there and then come back down, retest, build a new base. Looks like that will be the top, at least short term, and we do have these fundamental reasons that are driving silver higher, like the supply shortage. A lot of refineries, precious metals refineries, are switching solely over to gold right now because of the supply squeeze in gold, the higher demand for gold right now. And so I would expect that to continue, or at least to continue to be a driver of the price of silver forward here. So my target for silver is 35 by the election. Now, Bitcoin, last time I made a price target for Bitcoin, I gave 2 price targets, and really the main reason for that is because we don't have much historical information to look back on in order to determine, hey, when these fundamental things happen in economic cycles, Bitcoin reacts a certain way. It's only been around for a decade, right? And so with something like gold or silver or sovereign debt or currencies or even businesses and stock markets, we have hundreds or thousands of years of history to look back on and say, when these types of things happen, usually the result is A, B, or C. We don't have that with cryptocurrencies. We don't have that with money that's designed to be sound money, hard money that can't be inflated, but at the same time is completely lacking any sort of commodity value. And so we don't have the historical information to look back on. And so right now, the main driver of Bitcoin going up is, in my opinion, it's the knowledge of it. It's the widespread acceptance and adoption of Bitcoin as a store of wealth, as a medium of exchange. And the more people that hear about it and learn about it and know about it, the more adoption there's going to be. And that's the main driver going forward. But in the meantime, it's still extremely volatile. Now, you can chart it, and the charts do indicate that a higher level for Bitcoin near term, kind of a ceiling, would be that $15,000 mark, especially if we get a confirmation of the upside down head and shoulders, if that pattern continues to its completion. If not, if there's a retest and a drop, again, that $10,000 on the lower side, I would expect that's been some good support resistance. And so I'd expect a bottom around that $10,000 mark. So 10,000 or 15,000, those are my 2 price targets for Bitcoin by the election. Now, GDX is the next one we're going to look at. My price target is $55 per share on GDX by the election. It's an ETF that has just the index of miners in it. Now, obviously, if a company produces gold and pulls gold out of the earth, they are going to have larger profits if they can sell it at a higher price. And the higher price that gold goes to, the more that profit will be, and the more of these miners will actually start producing, because there are a lot of miners just sitting on the sidelines right now waiting for the price of gold to rally so that their profits are big enough and they don't waste, mining and producing all this gold at lower gold prices. And so I do expect that to be a huge tailwind behind gold miners right now. However, and this is a big however, gold miners are impacted negatively by inflation. Now wait, hold on. I thought that inflation would drive the price of gold higher, which would increase their profits, right? Yes, but inflation doesn't just drive the cost or the price of gold higher, it drives the cost of everything higher, especially many times energy. And after a long enough cycle, it also impacts wages. And so costs for miners do go up in inflationary environments, just as the price of gold goes up. And so while GDX and miners will go up as a function of the gold price going up, they do have an increase in costs as well. Now, usually their costs do not increase as much as their revenues, and so their profits grow, but that still impacts it. So it's not going to be a massive exponential, 2 or 3 or 10 or 50 times what the price of gold does for miners in general, but it's still a tailwind. So I do expect GDX to continue to go up, especially you looking at the chart here. They've been consolidating just like gold and silver have been consolidating. And as we break out, it might take, another week or a couple of weeks for GDX to break out of this consolidation pattern. But if we do, then the charts suggest that 55 would kind of be the next major ceiling, the next major stopping price for GDX. And another tailwind is the institutional allocation to miners. And we're already seeing some of that with like Berkshire Hathaway made tons of headlines. Warren Buffett allocating a small percentage of Berkshire Hathaway's assets into Barrick Gold. He also allocated a much larger percentage of his assets into some Japan trading companies, and they're heavy in precious metals and commodities and energy as well. And so as the environment looks to favor materials, precious metals, energy, more of an inflationary environment where hard assets are going to be benefited, that's going to drive more and more of the wealth to be allocated into companies that'll benefit from that, like gold and silver miners. Now, it might come as a shock to you that my projection for the S&P 500 is much higher than it's at right now, but there are a lot of things that are driving stocks higher right now, even if it is just a few stocks taking the averages higher while the rest of the market kind of lags or even falls. Now, one of those, and I think probably the main driver up until the election, is going to be coronavirus or COVID news showing more and more positive signs. It is becoming increasingly difficult for the media to continue to push the narrative that we're in a massive health crisis right now. As more and more data comes out, it's looking like the coronavirus and the COVID, the case numbers, the death numbers, the severity numbers across our country specifically are getting better and better and better, and it's becoming harder and harder for that narrative to hold, that it's getting worse and worse. And we're starting to see now even some mainstream sources start to show the information that, hey, it's actually getting a lot better here. Now, if you want my historical position on the coronavirus, you can go back in January. I was one of the first ones talking about this, especially from a financial perspective. In January, I made a video about the coronavirus and how to position your portfolio accordingly to something like a pandemic happening. And just like Nassim Taleb talks about a lot, in the beginning of something that, contains the possibility, contains tail risk, the possibility of massive catastrophe, you want to panic and prepare early. That way you prevent, you hedge against those bad things happening. In something like that, you don't want to wait and see. And it turned out that it wasn't as big of a deal as it could have been. And it could have been a very, very big deal. But it turns out it wasn't. And so the mainstream media has kind of done the opposite. At the beginning, they said, oh, it's no big deal. There's nothing wrong with it. And then when it was a little bit too late, then they started to panic. And now it's all turned political. But essentially, the real information coming out about it is going to look better and better and better. And that's going to be a tailwind for stocks stocks in the short term. I don't think that the coronavirus was the main problem. Obviously, if you've been around my channel at all, you know this. You know that I think the economic fundamentals across the board are deteriorating and crumbling, and it has nothing to do with the coronavirus. Well, it's something, but the coronavirus just kind of expedited this happening and made it a little bit or a lot worse, especially concerning monetary and fiscal policy response to the crisis. But it wasn't caused by COVID or the coronavirus. It was just made worse and triggered. Now, the other reason is that there's a lot of cash on the sidelines right now. There was a lot of money that sold out of the markets when this thing started to crash and has not gotten back in yet. A lot of the money that has driven stocks back up to these levels right here has been new money, newly created money that has been making its way into financial markets. Now, all of the money that sold out and waited on the sidelines to see if this thing was gonna, turn out to be really bad, turn out to be the next Great Depression, as the stock market continues to make new highs or continues to stay above its old highs from, before the coronavirus panic set in, that will be more and more of a confidence boost to investors to reinvest their cash since they missed out on the rally from the March lows. Now, economic fundamentals deteriorating, especially for small businesses all across the country, joblessness rates still being at crazy levels. All of these things, these are actually booms to the stock market because anytime you have shocks or crises or bad economic numbers coming out, it's going to be more of a reason for fiscal stimulus, for fiscal spending, for infrastructure plans or bills to get passed, for spending, for monetization of debt, for government spending, and in all of these things. Anytime there's new money created and pushed into the economy, that's going to push up asset prices soon. And so, yes, the economy is crumbling. Yes, that will push the stock market up higher, especially in the short term. Long term, probably not, but especially short term. We've got a lot of money in the Treasury general account from the original $3 trillion that the Fed kind of created for the response to all of this, and the Fed has been pushing for more fiscal spending, for more spending by Congress and the president get that money into the economy because it's sitting outside of the banking system. It's not being used right now as it's in the Treasury general account. So as that gets spent down, that's going to directly push up asset prices. Now, Treasuries, I don't expect any move here because we're at the zero bound with rates. That means as Treasuries get purchased and that price gets bid up, there's a zero bound there on the rates, and so they can't get pushed up that much higher because then the return becomes negative, and so no investors want to hold on to a negative nominal rate. They're already holding Treasuries, which are a negative real return. Most don't know that yet, though, and so there's that zero bound there. So Treasuries can't go higher in price, and the yields aren't going to go lower than zero, and so there's that zero bound there, and they're not going to do the opposite either because if bonds sell off, that pushes rates up. That means that every time government debt comes due and they have to roll that debt over into new debt, they have to issue new debt. They have to borrow more to pay off that old debt. They have to issue new treasuries for their current spending and to pay off their old spending. That means that's more expensive. That's like you have a credit card that you just ran out of your zero interest intro period. Now you have to go get a new credit card to pay off that old credit card, but the new one's charging you 18%. That's too expensive. You can't afford that. Same thing with the government. If rates spike, they won't be able to afford any new debt, let alone using that new debt to pay off their old debt, plus the additional spending, since they're not bringing in anywhere near enough for their expenditures from taxes right now. They can only rely on debt. And so if treasuries plummet because everybody's selling treasuries, that means rates spike. The Fed won't let that happen. The Fed will just has already put a floor underneath treasuries so that they can't sell off past a certain point. The Federal Reserve will just print money to buy up all those treasuries that are being sold by the market to keep rates low, to keep the government solvent. And finally, DXY. DXY, if you're not already aware, is an index that measures the dollar versus a basket of other currencies. And so the DXY has been on the decline lately. And my current projection for November for the election is that the dollar will hit 88. The DXY will hit 88. Now, again, this is not just an intrinsic inherent value of the dollar dropping because the dollar is dropping a lot faster and a lot more than that. The DXY is a a measure of the dollar versus other currencies. So all fiat currencies are being printed into oblivion. So the DXY is kind of a measure of, is the dollar being printed into oblivion faster than all the other currencies, or is it being printed into oblivion slower than the other currencies? So ultimately, I'm not, saying, that means that you should invest in euros, because euros inherently measured against things that are, a strong store of value over time are still dropping. It's just they're better than the dollar. And maybe it's not the euro, maybe it's the yen, but ultimately that's what the DXY is. It's just the dollar versus the basket of other currencies. We've got downward momentum. That means globally there's more selling of dollars in favor of other currencies. That's the direction, that's the trend right now, and that's a direct result of what happened a few months ago when treasuries were sold off, right? Because if you don't, treasuries are just dollars that produce interest for you. And if you don't want dollars that pay you interest, you definitely don't want dollars that don't pay you interest. And so if you sold off as a central bank or a hedge fund or a corporation or a company or whoever you were, if you sold treasuries and you got dollars in return, what are you going to do with those dollars? You're probably going to go take those dollars and do something else with them. And a lot of times that's buying dollar denominated assets like stocks or real estate in the United States. And so the dollar selling off relative to other currencies is a direct boom to United States assets, dollar denominated assets. Because as the rest of the world starts selling dollars, well, nobody else is going to take them. The only people who will take dollars, if everybody's trying to get rid of them, is the United States, because we're the ones that have to take them, right? And so if you're, around the world, you want to get rid of your dollars, the easiest way to exchange them for something that is going to serve you better long term is to buy a dollar denominated asset with those things like stocks and real estate. And so DXY heading lower is a direct boom to U.S. assets. And so that is one of the main drivers as well that leads to all of my other price targets that we just talked about here. In summary, gold at 2,500, silver at 35, Bitcoin at 10,000 or 15,000, GDX at 55, the S&P 500 at 3,800, Treasuries no change, and DXY to 88. These are my price targets for the election. I expect all these price targets to hit by the election. Now, just as a disclaimer, none of this is a recommendation. I'm not advising anybody to make specific investment choices based off of these. Everything on my channel, as always, is for educational purposes only. And I know these price targets are more aggressive than last time, but considering the environment we're in right now, it does look like they are warranted. If you have any thoughts or questions, please let me know in the comments section below. I always love hearing you guys' thoughts. And as always, if you like the video, hit that like button and the subscribe button. It really does help out the channel. I appreciate you guys. Thanks so much for watching. Have a great day.